All right, everybody. So I have CSX up on the screen. Okay. Before I even tell you what that is, what that setup is, I want you guys to, okay, good, Jake. I want you guys to take a look at that and give me your assessment on what you think this graph is like. What does this break down? What could this possibly be a signal? What options are potentially involved in this? Okay, so William, if we did a strangle swap, then you would have equal opportunity on both sides of the ledger, both up and down. Okay, what else? Come on, guys, take a look at this. What could this be a potential graph of? Come on. Okay, William, I could go along with that. Why do you say that, Jake, about 6% appreciation? I see you make money pretty much with any sort of upside move, even 10 cents, 5% or 2%. Okay, so when looking at a chart like this, you know, if you're just looking at charts, okay, first off, this is obviously an upside type of setup. So that could be just a call spread, it could be a call calendar spread. Okay, why could it not be? Why could it not be a short put spread? Okay, why is that not the graph of a short put spread? You're on the right track there, William. Chris, the opposite. It would have a constant profit to the upside if we had a short put spread. No, that's cool. I know you know the concept. That's cool. That's cool. There you go. Nice. Nice. So this happens to be a setup for a call calendar spread to the upside. Okay. What I like about this, two things. CSX has come out over the last, and I'm looking offline here, just over the last couple days and talked about their earnings, talked about some expense-related issues, lower taxes, which could drive its earnings. That's all come out over the last couple days. Okay, I like that. I like that the stock has recovered, which a lot of stocks have done, obviously, since the Christmas Day massacre. But what I also like is that the upside here, okay, if we look at the expected move, what is our expected move here on the upside? Okay, what is the expected move here, guys? I think it's a little bit higher than that, Mick. Okay, easiest thing to do here is if we look at the 65 straddle. The 65 straddles is trading about $3 and 20-ish cents, 3.25, and it's 10 cents in the money. So our expected move is just over $3. Okay, so just over $3 puts us right to that 67.5 to 68 area. Okay, now looking at the chart here, what do you see significant around that 67.5 to 68 area? Whoop, I didn't mean to do that. Yuck. Okay, what do you see here? Yeah, big time resistance, the 50 and the 200-day moving average. Okay? So if we get an upside move, it's likely that that move gets to that level, and then maybe it stops. If it's a blowout number, maybe it breaks through. But the fact that that 67.5 area coincides with what the expected move is fairly significant. And Joe, I totally agree with you around that 68 level. So that's going to be pretty significant. So if we get to that level there, that's ideal. So what I had up on the screen here is the 67.5 calendar. Okay? We could also take a look at the 68 calendar to see if that just gave us a little bit better bang for our buck. And by the way, this was not just a 1 week. This was going all the way out to February. Okay, so here is a 68er rather than the 67.5. So let's take a screenshot of this. And I'm going to put this on a Word doc, and we're going to compare. Okay, so this, I'm just off screen here. Hang on. This is the Jan 18th, Feb 8th, 68 call calendar for roughly, this would cost us probably 40 cents. Okay, and then we're going to now evaluate that against the 67 and a half call calendar, which is actually going out an extra week. So that's going to cost us roughly 60 cents, 58, 60 cents. And that chart looks something like this. Let me take a screenshot of that. So this is the Jan 18th, Feb 15th, 67 and a half call calendar for 55 cents. Okay, now let's compare these up on the screen. Okay, so this top one here, guys, this was this 68 call calendar for about 40 cents. Down below here is the 67 and a half call calendar going out one extra week for about 55 cents. When I compare these two graphs, which one looks to have the better reward to risk? Okay, which one of these has the better? Yes, Wally, you think the bottom one. Anyone else? Michael, you agree? Okay. Why do you guys say that? Okay, so the top one here, guys, remember the top one costs us 40 cents. The bottom one costs us 55 cents. They both max out somewhere in the 40 to 45 cent profit area, right? At roughly the same points. I would rather buy the cheaper spread if the profit potential is the same and have less downside risk because it costs me less. Does that make sense? So to me, the top one has better reward to risk to it. It costs less and has basically the same reward as the bottom one. So this is how I evaluate reward to risk. Now, the beauty of options and the beauty of taking our time and evaluating and looking to see where the best potential is that look at the two different setups here. Okay, the top one is Jan 18, Feb 8th, 68 call calendar. The bottom one is Jan 18, Feb 15th, 67.5 call calendar. Maybe there's one other call calendar similar that we should evaluate just to see what the reward to risk is. So, Chris, that would be a really good suggestion. The problem is there are no 68 strikes on Feb 15th. Okay, let me show you here. That would be the first guess that I would have had also. But when you go out to the regular monthly expirations, you don't get those dollar increments. What a show! Haven't seen that in forever. So what would be the other potential, looking at these dates and expiration strikes, that I would want to look at? Anybody, not just Chris. Come on, it's some combination of what we have up on the screen right now. Okay, let's say, Jennifer, that's a good idea. That's a good idea. There you go, Chris, that's what I'm looking at. I'm really looking to sell this week's option. So the one combination that I see that we didn't do yet, which Chris just said, would be the Jan 18th, Feb 8th, but the 67.5 strike. Let's just throw that up there and evaluate that. Okay, Roger, good job. So let's do that. Let's take this off of here and do this here. Okay, so now I've got the 67.5 calendar going out Jan 18th to Feb 8th. Probably cost us 46 or 47 cents. And let's see what this risk chart looks like. And I'll put this up on our doc and we can evaluate. Actually, I don't think I even need to when I look at this. They're all debits, Chris. These are all debits. Do I even need to add this to our sheet, guys? Take a look at this. Do I even need to add that in? Right? All I have to do here is look at this profit area down here, and it does not meet or exceed what we saw from the other setup. So no, I'm not even going to add this in. The cost on this, Chris, was 45, 46 cents. So if we go back here, to me this becomes, well, whoops, sorry about that. There we go. To me this becomes, you know, a fairly easy decision between these two. If we like, again, every trade you make, has to start with an idea, has to start with a conviction about direction, no direction, this, that, and the other. So if we like a more moderate upside play here, the reward to risk on this is really good. The reason I like the upside again in review here is really twofold. One, reading the notes about the company that they've put out over the last few days in terms of expenses, in terms of potential revenue guidance. And number two, I love the fact that there's such a strong technical magnet, the 50 and the 200-day moving average convergence, that coincides right up top with that expected move to the upside. So then again, you know, our goal, my goal is to maximize reward to risk. Any questions here? No questions? Okay. So I am going to put this out. I'm going to put this out with a 40-cent bid to it. Okay? So let me get that signal out. Let me get the video done. I'll get the I will get the spreadsheet out there. So Chris, again, I agree with you on that. This is all based, though, on the recent news in the stock, so fundamental news, and the fact that it's okay if they make another lower low here. If the stock goes right to that area of the 67.5 or so that we're looking at, I have no issue with that.